Thank you for sharing your Wednesday night with me. I am JB Bryan, the President and Chief Investment Officer at JB Bryan Financial Group, the home of AfroEconomics. What a wonderful day. We're talking about the frequently asked questions. You wouldn't know what they are because they ask me. Those are my questions that I get from you. Yes, indeed. Call me at 1-833-ASK-AFRO if you have specific questions for me. Yes, I hope that you know how important your questions are. That's why I do this. Because every time I'm thinking about our topics for an Afroeconomic update, which I'll be doing on Monday, or for our Wednesday nights, or for our members only meetings on Fridays, or for our Sundays at sunrise, every time I think of a topic, it is because of you. Something you asked, just something that I just feel that I have to bring forward for you. So know that whatever you ask, whatever you text, whatever you email, it is in the atmosphere and the answer will be brought to you. But we have to just take that effort. And I appreciate you taking the time out. The webinar participation is such a blessing. I really appreciate you. And to those of you on the AfroEconomics with JB Bryan Facebook page, I love you. We're just really feeling 7,000 AfroEconomics with JB Bryan people on Facebook, and that is hard earned. You all didn't click like easily. I have done everything I can to bring that financial empowerment to you, and I look forward to continuing to do that. Delia and I were working on the 2019 schedule, and I am making a serious effort and plan to make sure that we start off January in DC, then New York, then Virginia, then DC, then New York, then Virginia. I know, because New York and DC gave us so much love. And of course, we do so much in Virginia. We have the holiday celebration for our AfroEconomics Member of the Year coming up December 15th. Join AfroEconomics now, December 15th. That's going to be seriously blessed. And the MLK Afroeconomics Equality Day, yes, that's a Monday. That's King Day, Monday. And that's January 21st. So go to the events calendar and get involved. So let's look at the notes. Remember, call me at 1-833-ASK-AFRO, because when I start looking at my notes, y'all, it's going to be hard. So every time I go, we're gonna start with RMD questions. I know some people, when I sent that email to you, or you got the text, if you want to get the emails or the texts, I need you to go to AfroEconomics.com and subscribe. I need you to do that. So I asked, the first question was about RMD. And RMD is required minimum distributions. And it is one of the most relevant topics when it comes to individual retirement accounts. So everybody's always telling you, everybody that's in my business, we're always talking about IRAs, what you need to do, why you need to have an IRA. Well, when you have an IRA, you start hearing about the required minimum distribution. And individuals who save into an IRA are getting the tax advantage of not having to pay taxes. The taxes are deferred. So the taxation on the earnings, and quite often on the income that you made, you were never taxed on that because you put it in pre-tax. If you rolled over a 401k to an IRA, you never paid taxes on that money. And you haven't even paid taxes on the earnings on the money. Hopefully you made money. And then you also may have just done an IRA on your own, and you did it so that you could write off the contribution on your taxes. Well, the chicken comes home to roost. Individuals who save in a tax qualified retirement account are required to begin withdrawing a minimum amount each year from their retirement accounts when they reach age 70 and a half. So they're primarily, like I mentioned, pre-tax contributions. So they're growing tax deferred, the investment earnings. So the required minimum distribution asks that you start taking these withdrawals so that they can start getting some taxation from that money you put away. These rules apply to employer plans, also 401ks, 403bs, traditional IRAs, SEP IRAs, simple IRAs, Roth IRAs are not subject to RMD rules while the IRA owner is alive. But a Roth IRA beneficiary is required to take the distributions after the IRA owner dies. So, hey, there's always something to it. And that's why I love talking about taxation. I just love it. I remember, in undergrad where I was like, whoa, this accounting and tax stuff, this stuff is hard. But I still, because it was hard, I wanted to make sure that I did a double major in it. So I did accounting and finance. So, and because finance came easier to me. And then accounting was, I just want to know this stuff. I want to understand this. And I'm so glad that I pushed into that. I pushed into that and really went through. And I remember, really taking extra time, going to the teacher's hours and all that stuff so that I could talk about these things with confidence. Not to even mention though, because, school is talking about corporate finance, but this is about individual taxation. Required minimum distributions are an individual taxpayer issue. So, and all of this stuff changes all the time. So who cares? Even if I was, but I wasn't, but even if I was magna summa laude, caude, laude, whatever, all that stuff that existed when you get out of school is gone. Whatever the tax law was then, it's gone. All that stuff changes all the time. So the required minimum distribution requires that you be on top of your game. If you have an IRA, you can't just not pay it because you didn't know it existed. You must begin taking a minimum payment from your traditional IRA each year, starting with the year that you get 70 and a half. So the year that you turn 70 and 6 months. So sometimes it's the whole another year, another tax year, but sometimes it's the same. So if you turn 70 in the first half of the year, you're going to turn 70 and a half in that year. That's the year that you're going to get something in the mail that says this is the required minimum distribution out of your IRA. Everybody that's in their 60s, this is relevant because what? We need to start talking about it and planning, and many people are already taking out the required minimum distribution, but many people are not. And I'm always loving it when my clients and members are like, oh my goodness, I don't need this money. Hey, that's a good thing. That means they kept their debts down, they're doing the right thing, everything is, doing good, and they don't even need the money out of it. But doesn't matter, they still got to take at least that required minimum distribution. And, one other point I should add, it's like you might want to know like how much is required. Well, wherever you have it, they will send you the calculation. But the required minimum distributions must be calculated according to the IRS tax laws. So the minimum is determined by the amount of the account at the end of the previous year. So the required minimum distribution amount is calculated by taking your IRA's value, the account value at December 31st of 2017, the prior year, and they divide that by your life expectancy factor that is calculated. That factor changes each year because you're getting older. So each year you'll have a different required minimum distribution, plus your account value will be different at the end of each year. And if it's not growing, you're taking the withdrawal, and the amount is going to be lower, possibly because the amount that you're drawing out, your account is not growing, so you're taking money out of it. So the point is, we want to have the account grow at least at the amount of your required minimum distribution. You want some growth. So can you take the required minimum distribution from another account? That I hear all the time, because people think that if you have 5 IRAs, that the total amount has to come from each of the individual. Like if this one has required minimum of 1,000 and the other one has a required minimum of 2,000, that you have to do it by each account. No, if your total required minimum distribution is 5,000, you can choose to take that from your largest account or the smallest account, but you can take it from one account, but the total required minimum distribution has to be taken out of all of your tax qualified accounts. That amount has to come out. It doesn't have to come out of the exact account that it's from, but it has to come out in its totality from your money. And we can talk in greater detail about that. So is my required minimum distribution taxable? Of course it is. That's how the IRS makes money. Yes, they want you to take it out so that you can pay taxes on it. And then it says, what if I don't take a required minimum distribution when it's due? What if I don't take it? You can face a 50% excess accumulation excise tax. It applies to the taxable portion of the RMD amount that should have been distributed, but it was not. So that's scary. So an example, it says, is if an IRA owner has a 5,000 required minimum distribution for a year and failed to take it out, the penalty would be $2,500. 50% times the 500. I'm sorry, 50% of the 5,000 missed required minimum distribution. So the IRA owner must report that 50% extra tax using a specific tax form. So if that's a problem, talk to me and we'll get with your tax advisor. I'm your tax planner. Do you have your tax prep person? And we can communicate, what the error was and what you need to do, but that's why I love seeing your tax returns. That's why it's important that we talk throughout the year. It's just important. These discussions are important. Somebody is going to say, wow, that's what J.B. Bryan was talking about 5 years ago, 10 years ago, 20 years ago, whatever. Somebody, you on the telephone. We have people that have called in. They are wondering, what is RMD? Or they just got the form, or they got the form and they didn't know what to do. Yes. If you turn 70 and a half this year, you got to get with that required minimum distribution. If you stopped working, like if you're still working, you could be 75 and still working, have money in a 401k, and you don't have to take that required minimum distribution until you stop actively working and participating. Isn't that something? Work. Work. Look, that's one way. They're like, I'm not going to keep working just to avoid taking money out. I'm going to spend my money. Well, if you spend your money, you should know the IRS is pleased with you. They want you to spend your money and pay those taxes when you get to 70 and a half. That's required minimum distribution. Let's talk about, what do you think we should do next? Let's do life insurance. Got a call about this today, and I was helping. I've had about 5 meetings with members about Medicare and about healthcare enrollment and open enrollment. And I think a lot of people that are working and they have this open enrollment and you have these options and you want to have a better understanding of your insurance, You really need to take note of these things. Choosing health insurance that covers everything that you need, it can be really difficult. Everything is changing. The Affordable Care Act changed a lot of stuff. It is important for you to make sure that your health care plan is meeting your requirements. And your job might actually offer numerous different insurance plans, but they all are supposed to meet the Affordable Care Act requirements. So it's important, though, to carefully consider all of your health insurance options. First, I want you to make sure that you look at coverage limits and options. A good plan should have no lifetime benefit maximum. A good health insurance plan should have no lifetime benefit maximum. Remember that, like that movie Denzel did, and his son was really sick, and their plan like had a maximum, and they wouldn't do the surgery for his son, and all that. And he lost it. That we really, most plans out here have no lifetime benefit maximum, but don't assume anything. Make sure you check it out. Look at your out-of-pocket expenses. You need to know how much is your deductible each year. The deductible is the amount that you have to pay out of pocket before your insurance will start paying for part of the cost. That's the part that you have to pay, that deductible. Now your co-insurance, check that too. These are all we're talking about out-of-pocket expenses. Your co-insurance is the amount of each bill you are responsible for after the insurance company pays its part. The most common co-insurance amount is 80-20, where the insurance company pays 80% and you pay 20% of the cost. Look at the out-of-pocket maximums for each plan that you're considered. That's once you reach that limit, your insurance company will cover everything except for co-pays. Co-pays, that's what you're going to have to pay. If you have a high deductible health insurance plan, your maximum out-of-pocket cost should be what? The same as your deductible. And then look at your total maximum cost. Add up how much you will end up paying for each plan to compare. If the worst thing were to happen to you, look at your total maximum cost. And then also, there's a whole bunch of high deductible insurance options out to help you reduce your costs. Make sure that you consider them, but look at that maximum out-of-pocket cost. Be very careful and be aware. And, you can't just buy things because it really depends on how much you think that you're going to need it, right? Once you found a good plan you feel comfortable with, it's important to make the most of the health insurance that you get. Read the book, read all of the benefits. Make sure you understand all of the differences and everything that changed from one year to the other. Even if you're going to stay with the same company, what has changed? Read the policies, read the book, see what you're going to be charged for different services. Be careful. How much will it cost for x-rays? How much will it cost for urgent care? How much, I just check on everything, right? Those are some health insurance key points. Hey, y'all, look at y'all participating. Call me if you have a question. We're going to go on to how to determine when a person asks me, like, how do I know when it's time to retire, right? 1-833-ASK-AFRO. If you have a specific question, this is a powerhouse opportunity. This is your time. This is your time. Okay, here we go. Let's get back to what I said, I wanted to address the retirement question. How do I know when it's time to retire? There will come a time when you are thinking about it. You just don't know when is the best moment. So here are some key things that I think that you should think about, because nobody knows the answer but you. Remember that time I did a webinar on questions that only you can answer? Well, that's one of those things. I can only direct you in some things that we want to think about. Now, this first one, it is my job to make sure that it happens. When you have enough money for your retirement that you want, that's when you can retire. That could be a good sign that you're ready to retire because you have enough money to retire. Let's see how you could, let's just think about it. What about, like, you can calculate, if I have enough to retire, if you think about how much does it cost me to live each year, and then just multiply that by like 25. Say you just, for 25, how much, if it was cost you 50,000 a year, to live, then for 50,010, that's only, that's $500,000, but that's 10 years. Then you got another, I'm telling you 25. So we're looking at 1.2 million to calculate if it costs you an annual living expenses of around 50,000. But if you can reduce your annual living expenses if you have a pension, right? If you have a pension, then you said 50,000, but if 30,000 of that 50 is coming from your pension, then your annual living expenses are actually only 20. And that would bring that 1.2 million down, way down from what you would need to supplement that. Maybe you are ready to retire. So in summary, generally speaking, if you take the annual expenses you expect, multiply them by 25, you'll be in the ballpark of what you'll need to retire comfortably. But we got to, look at that, because you would have thought, 50, and I don't have that. I don't have 1.2 million, because you wouldn't have thought about, and that's what I'm there to help you through, that, wait a minute, what about the pension? What about that pension and this other pension, another pension? A lot of people have several pensions. Social Security. Also, we can reduce it by that amount, what you need. So a second question, then we're talking about, how to know when you're ready for retirement. And then, are you required to take distributions from your retirement plan, right? Are you at 70 and a half and they're forcing you to take distributions from your retirement plan? They're forcing you to take income. So you're like, well, I'm saving and saving and saving and saving, but now they're forcing me. Remembering that you can delay your 401k distribution until after you stop working, but you cannot delay the money that's in an IRA. So when we roll it over to an IRA, it's generally because you're ready to stop working. So you can collect, can you collect the maximum in your Social Security? Like 62, the minimum, 66, maybe, but full, no, not even the full 66, the maximum 70. So that would mean, are you 70 and they're basically forcing you to take your Social Security? That might be a sign that you are prepared to retire. Are your expenses the lowest that you've seen them, in the last 20 years, or you have no debts, have very little bills, your house is paid for, and your kids are out of college, and your expenses are extremely low. That could be a sign that you are definitely prepared for retirement. Oh, what about if you hate your job? You hate what you're doing, you don't enjoy going into the office anymore. That could be a sign if you've got all this other stuff checking, right? Because if you don't have your money straight, you might have to just switch jobs. And unfortunately, a reason for considering retirement, from too many people, But we know that 10th principle of AfroEconomics, Black health and Black wealth. But if your health is declining, that may mean that it's time to retire. Do your family members want you to retire? Is your boo asking you to stop working? Are you, and if you did retire, are you excited about the future? Are you confident about it? Well, those are some things that, like when we're in a meeting, I'm asking you things, but you might not know that, you know, but that kind of just allows me to like summarize like what I'm thinking. Like if I ask you these things, you might not answer and you're like, oh yeah, or no, or whatever. But if I'm collecting this information as we're talking, and then if you weren't, then, you know, that's what I'm here for, to say that maybe, you know, we should give it another year. Let's work on these things. Let's work on this, or have you considered retiring? This could be time to go, right? Hi, everybody. So we have talked about health insurance. We've talked about required minimum distribution, what it is, when it's time. We just talked about retirement. Oh, we are doing this thing. Let's see. Let's go to, okay. And the other question is, oh, I think this is our last one, unless someone calls. This is about life insurance. How much life insurance do you need? Well, first, before you like think, like people act like it's like an assumption, like everybody needs life insurance, you know, because I guess you go to work and one of their benefits is life insurance. So you think, well, that everybody needs life insurance, right? Well, that's not necessarily true. It's not. So first we have to decide, like, do you really need it? And then the answer to that is, I mean, how to answer, like, do you really need it, is to say, does anybody depend on you financially? If there's someone, anyone, your mama, your grandma, your husband, your niece, your children, if there's anybody who is depending on you financially, then yes, you should consider life insurance to protect those who are depending on you financially, right? And so then how do we decide, like, how much do you need? So there's like a rule of thumb. Like I saw this like at the State Corporation Commission one time, and they like had this book, and it was talking about, you know, one way to calculate, you know, life insurance and the amount is to multiply your income by 10. But that doesn't really consider a lot of things. Like it doesn't consider, if I just multiply my income by 10 and I say, oh, that's how much I need, well, I might actually buy too much, because you might not really need that much, because you might have, you know, $100,000 in savings or 200,000 in a retirement account. Like you might have other life insurance policies, and you're not you're not considering them properly. So the you know, just multiplying by 10, I think it's just too simple. Another rule of thumb that's out there is get 10 times your income plus 100,000 per child for their college expenses. But it really doesn't go deep into all of the family's needs, nor do you know if 100,000 is going to be enough or too much for those college expenses. So it really still is not looking deep enough into the family needs. And then there's another calculation that is used sometimes called debt and final expenses, called DIME. D in DIME is debt and final expenses. I in DIME is income. M in the DIME is mortgage, and E is education. And I like that one more because it does include more. You know, it's much more comprehensive, but it still doesn't account for any life insurance you already have, any savings that you already have, and then it doesn't consider that the contributions of what it would cost to cover a parent that does not work. So in that case, so we need to, look at that situation. Like, say you have your spouse doesn't work outside the household, but if that spouse were to pass, it can't. You're taking out that whole income. So the income, if that person doesn't work outside the household, you're considering that as if that income section doesn't matter for them. When it does, because you would have, if you have a spouse that's taking care of the children full time or something like that, that's a serious expense. You might need a full-time nanny if you didn't have that spouse. So, those things are not considered. Well, and that's why we have to look deeper into your specific family finances. So I would calculate it more like looking at annual income, the mortgage balance, any other debts, future needs like college, final expenses. You can include like funeral costs as well. Some people just buy insurance only to cover the funeral when they still have mortgages and everything that need to be paid off. And then, of course, if the person that we were calculating it for was a stay-at-home parent, we would have to include the cost of providing the child care and the services that they provide to the family, and then take out. So all that's plus, and then subtract out existing money that you're already saving for college, any current life insurance policies that even if you might have them at work, and then any savings, investing that you have that will be used by the person depending on you, if they're the beneficiary, of course, right? So it gets really complicated because you might have, we include savings and investing, but it's not going to go to your spouse, because, or it's, we subtract out assets like some real estate, but your partner is going to actually take it over if something were to happen to you, or you only get half the value if something were to happen to you. That, so it's more detailed than we give it credit for. But we do need to seriously consider life insurance, seriously consider the type of policies, seriously consider the use of having the proper amount of insurance and then getting it in the right portion. Like you might have some permanent policies and combining it with some term policies, or you might have to have all long-term term policies. But this is the thing that we need to consider thoroughly in that calculating the amount and looking at your cash flow and seeing what type of coverage, because a lot of times people, because of limitations in their budget, the agent unfortunately sell you the policy that you can afford, but it's not the proper protection. So you have $300 and you buy a permanent policy and you only got $100,000 in coverage, or you can get a 30-year term for that $300 a month for a 30-year term policy. And you're not accumulating any cash value, of course, but during that time period, you might need more than $300,000. You might actually need that $300 to go towards $500,000 of term. That's the take home from that. Make sure that when you calculate how much you need, then you have to realize that there's no compromising. If my family needs $1 million coverage because of these bills that I have, then you can't just say, well, I'll just buy this one because it's permanent, but it's not enough coverage. We've got to be careful. We have to be careful. Think these things through. So those are interesting. Thank you, Dr. Hicks. Thank you all so much. So we talked, let's just summarize before y'all scout. We talked about how do we know when it's enough life insurance? Y'all gonna have to tell me if I missed out on one of my questions. We talked about health insurance and determining it. This is open enrollment season. for so many people. Be very careful, conscious, look at them again, make an appointment with me if you want to have a person to take a second look, work plan, not a work plan, whatever it is. If you need some coverage, you know, I'm licensed in insurance, life and health and car and home. And, you know, so, you know, I'm there for you. Get the help that you need. The required minimum distributions, the year is coming to the end. If that's applicable to you, you need to check it out. If you're 70.5 and you're wondering what's going on, you haven't gotten anything in the mail, you don't know what to do, talk to me. Talk to me, because IRS doesn't care. Oh, I didn't get it in the mail. They don't care. They do not care. They will penalize you if you don't do it correctly. So and then the life insurance calculation, the health insurance, the questions, the key questions to think about, we are on the ball. I like this. I really enjoyed this tonight. But also, again, make sure that you email me, jd@afroeconomics.com, if you have any additional questions. Those are the most frequently asked, some of the most frequently asked questions that I run into frequently. How are you doing, Dr. A? You all are so wonderful. Don't forget, December 15th, members, AfroEconomics celebration, and we're having fun. Trophy to our members of the year. It's going to be a wonderful celebration, and then a fabulous lunch. And then Monday, we're doing the King AfroEconomics Equality Tribute. Thank you so much for your time. Please share this with your friends. I will also take the time to post it into our AfroEconomics with JB Bryan YouTube channel. You're the best. Hi, Michelle. Thank you, Mr. Benta. Thank you, Ms. Sherman. Thank you so much to the banks. Thank you all so much. Thank you, Valron. Thank you. Thank you, Mr. Smith. Look at you. I can't see everybody's name. Thank you, Maurice. That's so cool. So good to see you all. Thank you. Thank you, Don. Thank you. God bless you. You all be good to yourself. And I look forward to talking to you Sunday at sunrise. Be empowered. I'm JB Bryan. Bye.